Hi, I'm Chaplain Mike from American Patriot the III. This is the third video in a series where I was going to teach you why I know that there is going to be an economic disaster coming upon America. I was planning on going into the history, where we're at today, lay out all the facts, how you're being deceived, and what to expect in the future. However, someone else has already made that video, a gentleman by the name of David McElvany, and he's done a much better job than I can do. He's more eloquent when it comes to economic things, and therefore I put his clip into this video. I think you'll appreciate it, and if you, after watching this video, are not motivated to make sacrifices in your everyday personal life in order to do better prepping and to secure a future for your family and your country, then there's something wrong with you. This is a heavy video, no fun and games. Time for fun and games is over. Please listen up. And you know what, you'll be glad you did in the future. So in the video after this, then we're going to get into practical steps. I don't want to just preach doom and gloom, but I want to give you practical steps that you can take to prepare. Like I said, you know what, I believe that God is going to look after the people that are trying to see his country through. Anyways, enjoy David's speech. You won't enjoy it too much, but you know, you'll certainly learn a lot from it. I make a few comments as we go through it, and because he is a little bit passive, more passive than I would be, but anyway, so I've made a few comments. Enjoy the video. Stay tuned for the next in the series. Take care and God bless.
Well, thank you, ladies and gentlemen. It's wonderful to be here with you. There is a lot of things to talk about, and it's an interesting question. Can America endure the coming years? We've been through difficulties, and if you're a student of history, you know that the people of God have been through difficulties time and time and time again, and drawing near to God have worked their way through it. So regardless of what America looks like in the future, we know that we as God's people can work through whatever travails may come, be that of a social nature, a political nature, an economic nature. And you know, tonight we're going to talk about the dollar and, unfortunately, the death march that it is on. We're going to talk about the bond market, pressures there, because it's the bond market which enables us to live beyond our means as a country. We continue to issue IOUs and finance a lifestyle that we simply can't afford. And we'll then look also at the metals markets and a few comments on the stock market as well, to just give you a broad overview. We should start with some perspective. We look at the declines and see them in many different areas and see that there is a correspondence. I don't know that it's causal, but I think there is a correspondence between the monetary economic decline that we're currently in, the social and political decline that we are also currently in, and the moral and spiritual decline that we're presently in. We see these deteriorations occur, and I think if there's one thing that I find particularly encouraging, it is that every 100 to 120 years, there is renewal. There is a spiritual awakening, and this goes back to the cultural cycle which Chuck was talking about last night, in which dependency is the last stage before really the hardest times and then a restart. There is opportunity from an economic and financial standpoint, but setting that aside for a minute and keeping this perspective triangle in mind, as things change, there's equally opportunity in the moral and spiritual realms as well as the social and political realms. There is an opportunity for significant change once in about 100 years. And I think it serves us well, it will serve us well to consider our role, to consider leadership, to consider demonstrating truth, to consider a life well lived and what that looks like to our neighbors, our friends, our family members and colleagues, because as the foundations crumble, I think people will look to the remnant in order to know how they should respond and live, the choices that they should make. Again, whether that's of an economic nature, there is this correspondence, but I think opportunity in each sphere. So for those with eyes to see and ears to hear, as difficult as things get, understand that at least in the last 600 years of British and American history, we have seen this repetitive cycle every 100 to 120 years, where unfortunately each of those periods in 600 years has ended with either international conflict or internal conflict, civil war, or some sort of a war with neighbors. And that really is a deterioration. It's a deterioration. We've, for 5 or 6 years, looked at a progression, kind of what we would call a domino effect, a crisis domino effect, starting with a financial crisis, that financial crisis here in the last decade, opening up to an economic crisis being a domino which then falls into a political crisis. And then ultimately, as we see scapegoating and the policymakers in Washington and your major power centers around the world unable to take ownership of the policies put in place, which have destroyed the fabric of society, the markets, and our great republic, then you end up with geopolitical scapegoating. And this is the nature where, again, it's either you blame the southern states or the northern. We've done this before. We've seen this happen on our own soil. We had that during the Civil War. But if it's not someone who's your neighbor, then it's your neighboring country. And so that's the fear that we have. And clearly it's a concern because there's a real consequence. Lives are lost, fortunes are lost. But understand that grace abounds, and God is in the midst of that, and God is always in the midst of his people. So making wise decisions has never been more important, and I think the legacy that we carry, yes, I mean, when you think of who you are as a working person, as a saving person, as an investing person, you have a financial legacy to consider. But far more than that, we collectively have a social and political legacy. And that's something that we need to be cognizant of. What are we leaving future generations? And that moral and spiritual legacy as well. And obviously, as the basis of this triangle, this basic illustration, the foundation of it. I'm going to ask you to do 3 things. I'm going to ask you to do 3 things tonight. One, I want you to watch. I want you to watch The Fuse is Lit. It's a DVD. We do sort of a State of the Union presentation each year for our listening audience and clients, just to kind of let people know what we think is happening around the world. This has 3 parts to it. I think we've just run out at the booth, but certainly you can contact us, contact our office, or leave us your contact information, request it at McIlvaney.com. Part 1 dealt with Europe, Part 2 dealt with China, and Part 3, and Asia in general, and Part 3 dealt with America. And we look at things very broadly from an interdisciplinary perspective and try to see what is happening and what are the consequences, policy decisions that are made, and the either intended or unintended consequences. The other thing I would like to ask you to do, the second thing, is to listen. Listen to the McIlvaney Weekly Commentary. You can find it at McIlvaney.com. That was mentioned earlier. Each week we have very interesting guests on. When we don't have interesting guests, we have a conversation with ourselves, which is even more interesting at times. So I would ask you to watch the DVD. That's compliments of us and very informative. It's something that you can share with friends and family members to sort of help them have perspective as to what's happening in the world, again, from a political as well as an economic perspective. And lastly, I'm going to ask you to read 2 books, and I'll recommend them at the end of the presentation. As we wrap up, I do have 100 copies of one of those books with me. I thought about this months ago, ordered the books, had them delivered, and then when we got here, there's these 2 unmarked boxes sitting, waiting, and I couldn't remember what they were. And we opened it up, and it was like a Christmas find or something. It was wonderful. So it's our gift to you. But I brought 100 copies, and it's something that, again, I think ties in hope. There is a basis in our monetary and economic sphere, which we had starting in about the 1860s. And we lost progressively from 1922, 1933, 1944, 1971. The slow deterioration of our currency system as we moved from a gold-backed system to an entirely fiat system, fiat meaning nothing backing our currency whatsoever, just a paper promise to pay. This is a roadmap, this book that I'm mentioning, is a roadmap back to that. And I think it'll be very helpful for you to understand what value it brought, the stability that it brought, being on a gold standard, and how easy it is to implement. So for your consideration, I'll mention those at the tail end of the presentation. We're at the end of an era. We've had growth in the economy, which has been fueled by exponential growth in debt. We've had 40 years of debt expansion, and we're now reaching our natural limits. Now, the issue is that memo didn't get passed to the Treasury. They're in the mode of issuing new treasuries all the time. That's just what they do. And the Fed is there to enable that. They would like to prop up what worked, and I use that term loosely, but what today is broken. We've got structural issues which have to be addressed. First and foremost, the fact that our country is bankrupt. We have so much debt, there is no means of paying it off unless we behave unethically. We've made a promise to make these payments. Now the question is, will we do that? And we'll talk a little bit about what the options are from a policy perspective in a bit. There is an economic realignment which is occurring, and right now you have the Fed and the Treasury that are choosing the winners and losers and are determining this by the policies they're implementing. We've had ZIRP, which stands for Zero Interest Rate Policy, QE, quantitative easing, a fancy way of saying we print money out of nothing and we go buy assets in order to support those asset prices, whether that's in the real estate market or in the Treasury market. I mean, and all of you know, $85 billion a month has been what they've been doing for this last little while, but that's not all they're doing. But $85 billion, that's split between mortgage-backed securities. So if you're looking at stability in the housing market, you're looking at stability in the Treasury market, understand that stability is bought. It's bought and manipulated by these policies. And it's creating economic inequalities, again, sort of the rich getting richer, the poor getting poorer, because you do have asset price inflation as a consequence of all this money printing and the $85 billion a month. And who is it that loses? Households lose. Who is it that wins? Big banks do, because they have access to the cheap credit, and big government wins. And we'll look at that a little bit under the term financial repression. We'll define that for you in a few minutes and look at it. From 1964 to the present, we've had the credit markets grow from $1 trillion to $57 trillion. The credit markets today, I should say the economy today, is no longer driven by production and savings and investment. It's driven by growth and debt. And that's what we mentioned a moment ago. We now are so dependent on debt. We have this codependent relationship with debt. If we don't grow our debt by a minimum of 2% net of inflation per year, we will be in recession. It's the math, it's done. You have to have it. So on a $57 trillion base, you have to grow a minimum of $2.2 trillion a year in the debt markets, in the credit markets. Otherwise, we will be in recession. Now, I'm not saying that we need more debt. I'm just saying that we have a system that is so sick and dependent on it that the system as it is today will fail without that regular input. It's not the way it's supposed to be. It's not the way it has to be. Ultimately, I think it's not the way it will be, but that's, I think, on the other side of an unwind of the debt that we have. Again, kind of a move away from production, savings, and investment, and today the only driver of debt or in the economy is debt. What you have illustrated in this chart is our debt compared to our gross domestic product, the total size of our economy. And Reinhardt and Rogoff said that 90%, these are some academics who a few years ago said if you breach 90%, you really are in trouble. Well, we're at 105. We're at 105%. And see, this is what I mean by the old model and the Fed and the Treasury still going back to the old model and not realizing that it's broken. (1947 to 1952), we had $4.61 of growth in the economy for every $1 growth in debt or in our liabilities. 1953 to 84, it was 63 cents. Pretty dramatic decline. 63 cents of growth for every dollar in debt. Now we're down to the present decade or so, and we get about 8 cents of growth for every $1 in debt. So illustrating the law of diminishing returns, we continue to add more and more debt, but it's not doing what it used to do in terms of growing the economy. So we're sitting over $17 trillion. I say over 17 trillion. You realize we've been over 17 trillion since May. Jack Lew borrowed from the G Fund, that is the Government Employee Retirement Fund, so that he could, and this is, I mean, he called it extraordinary measures. It was just kind of a shell game. They do this a lot. But if you noticed, from October 16th to October 17th, there was a jump in the national debt of $300 billion. We have nothing better to do with our time than look at these things. So $300 billion in one day. Well, it had already been accrued. The money had already been spent. They just had to go ahead and pay back government retirees because they had borrowed from their pension assets to keep the government going. Okay, so this is, I mean, again, we're at a crisis, point of crisis, and there's things that come out of this crisis which are absolutely annoying and require, I think, us to hold our political leadership accountable. It doesn't matter if you're Republican or Democrat. Today, you understand what the game is. The game is you bring back as much in terms of the tax take to your constituents. And you don't get reelected if you don't bring home the bacon. Mitch McConnell, in this whole thing, got a $2 billion project funded. I mean, in this whole thing, what am I talking about? The debt crisis. We finally got a signature. Everybody agreed. We averted this major thing. And he walks with $2 billion to work on a dam project, and I mean a DAM project. Where is the accountability? There is no accountability. This is the end of an era. We're seeing the flows out of dollars. We're going to look at a few charts here in just a minute that show foreign trade, imports and exports, and also sort of tax receipts and things. Some of this will bore you, but it's really important in terms of what is driving the markets, and ultimately what is driving consequences of asset prices and risk in the asset markets. $132 billion is, so far this year, what has come out of the U.S. Treasury market. That's foreign holders of treasuries liquidating treasuries. They're net liquidators. For years and years, they have helped finance our budget deficit. We spend more than we bring in tax revenues. We finance that. And they've been willing to foot that bill. They've been willing to give us capital in order to keep the game going. And now they're beginning to move the other direction. It's a trickle today, what we think could be a flood, and our real concern would be with rollover risk in the period of 2015 to 2016. Rollover risk, is when you have a debt that comes due, like a balloon payment or something, if you have a maturity for a debt that you owe. You have to either make new arrangements, roll it over, push it off into the future, or pay it off at that point. And if you look at the maturity structure of our debt, we have a lot of IOUs coming to date or to maturity. They were actually all clustered. We had about 60% of our debt clustered in the 2012-2013 timeframe, and with low rates this last year, they refinanced it. Corporate America refinanced their debt in this low interest rate environment. They refinanced for 15, 20, 30 years. They bought a ton of time. Burlington Northern financed 100-year paper at about 5%. Our government just pushed it forward a few years because it was cheaper that way. And so the debt that they refinanced, they pushed out into that 2015, 2016 timeframe. So when I say the fuse is lit, the title of our DVD, in our debt markets, the fuse is lit. It's lit. We have international creditors. As I mentioned, they're liquidating their treasuries. At the same time, they're shrinking their maturities and making sure that they don't get caught. If we have an interest rate spike, the value of bonds plummets, and they're sitting on a lot of bonds. The longer your maturities, that's 20, 30, 40, then those are more interest rate sensitive. They're shrinking to the stuff that's less vulnerable. Because what do they see? They see that we're bankrupt. They see that we're politically inept. They see that we're spending beyond our means, and they're not willing to live with the consequences of our bad choices. So yeah, consequences, loss of reserve status. We are the world's reserve currency. We have been since 1944. haven't deserved it for a long time, but we've kept it in large part because there's no single currency which can represent an alternative. The euro has gone from being 0% in terms of central bank reserve assets to now about 24%, and we're shrinking. We were about 72, almost 73%, now we're 60% in terms of the currency which central banks hold as a reserve asset. We're diminishing in importance, the euro is increasing in importance, and it's our contention that the Chinese are establishing themselves in international trade through bilateral trade agreements and through the acquisition of massive amounts of gold to at least compete on the world stage with the dollar and the euro. Nothing will ever replace the dollar, and I think that's sort of a misnomer. When you think of the dollar crashing or losing its preeminence, it's not that it goes away. It's just that it becomes less important, and that makes a big difference. I mean, if we have to share the world stage as a world reserve currency with two other currencies, in terms of how capital flows, the net consequence to you is that the goods and services that you buy at the grocery store are going to cost you 30 to 50% more. You tell me if it's in the budget. Is it in the budget? And we're talking about across the board. So oil's more expensive, groceries are more expensive, T-shirts are more expensive, tube socks are more expensive, and if you can't afford everything being 30 to 50% more expensive, sorry, that's what comes with losing reserve currency status. An increase in financing costs, that's a given. I mean, I'm talking about an increase in interest rates. This is really the fiscal disaster for the U.S. Fiscal disaster, we have 81% of our total tax revenues which go to mandatory payments being Social Security, Medicare, Medicaid, interest on the national debt. Interest on the national debt was supposed to be $250 billion last year, except that we had interest rates creep up. Did you see that happen? April, May, June, interest rates started moving up. Guess what happened to the interest line item in the national budget? The estimate was off by 60%. It wasn't $250 billion. That's interest only. That's not paying back principal. $250 billion. It ended up being $415 billion, and we just closed out the fiscal year 2013. Again, in a rising interest rate environment, the debt that we have becomes unserviceable. The reason I say, mandatory payments make up 81%, we just had one line item go from 9% to almost 16%. And we haven't seen anything yet in terms of an increase in interest rates. Everyone knows that they're well below a normal rate. So the wheels come off in Washington. The wheels come off in Washington as and when you have an interest rate increase. Why? Because the interest on the national debt becomes unserviceable. And of course, we reduce our international clout, both financial and in terms of foreign policy. I think that's kind of a given. The next chart looks at those federal receipts versus expenditures, and in England they say mind the gap. This is the gap. The red line is what we're spending. That's way up there at about 3.6, and then the blue line is what we're bringing in revenues. It's about 2.4. I mean, again, you can't run your household this way. You'd never teach your kids how to manage a checkbook or take care of their own finances and say, hey, listen, you don't have to mind the gap. We've got a gap. That's what they call a deficit. And this is what is hurting us more and more. This is the budget deficit. And again, expenses exceed income. This is really critical because the next chart explains how we can get away with it. We have a budget deficit, but if we're willing to run a trade deficit, work with me here. When you run a trade deficit in one country, you end up creating a surplus of dollars in another country. Those surplus dollars end up being reinvested in the deficit country. At least this is the way it's worked for us, and it finances our budget deficit. So by running a trade deficit and creating a surplus in China and Japan, the Chinese and Japanese take those surplus dollars, reinvest them into treasuries so that their currency doesn't appreciate, and they thus maintain a competitive trade advantage and get to sell lots of goods. They continue to get to sell goods to us. And what do we get? By running, by the government, by encouraging individuals to spend beyond their means and buy stuff they can't afford, creating that trade deficit, creates the surplus dollars that keeps the whole game going and allows government to spend more than they have coming in. Little convoluted, but that's reality. That's Washington, slightly convoluted. So again, imports and exports, the blue, imports are in blue. We're bringing in more than we're exporting. That creates that trade deficit. This is the cast of characters running the show. Mario Draghi. Mark Carney is the new fixture at the Bank of England. Mario Draghi is with the European Central Bank. Mr. Kuroda is running the Bank of Japan. And Bernanke, at least until Janet Yellen takes the helm, is still there. We've had the most stimulus on record here in the last few years, and the slowest recovery on record. And that should not only tell you something, but should be a little bit worrisome. In the last 100 days, between the Bank of Japan and the Fed, they have created fiat money, ex nihilo, out of nothing, $500 billion between these two banks. 500 billion. This is, I mean, money printing on a scale that you'd have to go back to the Weimar Republic to have an appreciation for. So what's important to realize is that, particularly in the U.S., none of the guys running, and gals running the Fed, are bankers. They're running our central bank, but they're not bankers. They don't have any practical experience. They've never run a regional bank, a national bank, a money center bank. They're all academics. And they've all written these masterful, brilliant theses, rhymes with, and they think that they're perfect and don't stink. Well, I mean, that's what we get to live with, is the unintended consequences of policies that are being put in place by academics with very little common sense and real-world experience. They're forging our future. Long-term structural issues, long-term structural decline in GDP. This is growth rates in GDP. GDP, again, our gross domestic product, total size of our economy. And it's been in decline for a long time. It's been moving lower and lower. And what the government does to kind of cover over the decline is like what they did this year. They added $560 billion of things that used to be categorized as X, and now they're categorized as Y. The net effect was, instead of having 1.1% growth in the second quarter, we ended up with about 2% growth. So the GDP growth rates were improved because through accounting wizardry, they recategorized $560 billion. Now, was the economy that much better off by $560 billion, or was this simply accounting chicanery? The kinds of things that Jeffrey Skilling was held account to and ultimately Arthur Andersen went under for. You don't get to do this in the public sector, or in the private sector, but if you're Washington, you make up the rules as you go along. This is the Fed funds rate. This is sort of government-issued optimism, if you will. Cheap rates, in reality, they are a form of price controls. And the reason I wanted to take this back to 1950 is because what you should know is the Fed is constantly trying to adjust and adapt and manage the economy. I don't think it's their role to manage the economy, but on a self-appointed basis, they're trying to manage the economy. And so they're adjusting rates to increase credit or decrease credit so that things either don't overheat or move to sort of what they call a disinflationary or deflationary environment. What you'll notice is the flat line. The flat line represents life support for the economy. I'll move to a close-up picture of that so you can see what happened. Bear Stearns, they collapsed, bankruptcy of Lehman, and then we introduced the zero interest rate policy. And again, this is unprecedented in U.S. financial history and world history. You don't get to keep rates this low for this long. This is more direct stimulus for a longer period of time than we've ever had in recorded history, and we can't get the economy up and running. I mean, so again, with that in mind, how's the economy doing? I mean, we've got more stimulus than ever, and it's still just sputtering. So that's what they've called a jobless recovery. We have had asset price inflation. In other words, they've printed money, and the money has found its way into the stock market. S&P is at new all-time highs. The NASDAQ on Friday was at 13-year highs, and we're supposed to be impressed by this. But I'll get to asset price inflation and the Cantillon effect in just a minute. This is how, by the way, this is how the Fed is financing our debt. You drop rates to zero, and you take what would be household income, right? I mean, what have you got in the bank? $5,000, $10,000, $500,000. If you were expecting your investment income to supplement your fixed income in retirement, guess what? It's not there. Where did your income go? You might think that it doesn't exist. Actually, with rates that low, all it's doing is subsidizing the federal government's large amounts of debt. So income redistribution should have been yours. Now it is going to finance the speculative activities of Wall Street and fund the national debt. The Chinese did this to rebuild their banking system after a banking crisis in the 1990s. This is what, in the world of finance, they call financial repression. Take from you, give to him. It happens all the time. It happens all the time, but it's a concept that most people don't appreciate. You look at that chart and you say, well, what happened? This was a choice. This was a deliberate choice, and yes, your pocket is getting picked. This is the crowd that we have to be concerned about in the debt markets. This chart shows the foreign holdings of our treasuries. So this would be your foreign central banks, foreign financial institutions, and again, they've been only too happy. The Chinese and Japanese, they're the two largest buyers. They've been only too happy to buy our treasuries as long as the middle class in America continues to buy their goods. China's in an interesting juncture. Japan is a different story altogether, but China's in an interesting juncture in that they don't want to be dependent on exports anymore. Export mercantilism is not their business model any longer. And the new business model that they have is, unfortunately, I mean, Chuck, you mentioned this the other night, that becoming consumer cultures, is that really what we should aspire to become as a consumer culture where our economy is driven by 70% consumption? Well, the Chinese look and say, hey, it's worked pretty well for the wealthiest nation on the planet. And so consumption as a part of their economy is less than 35%. Ours is 70%. They figure if they can become a consumer-oriented culture, they won't need to export. They can just be internally generative in terms of their growth. What's the catch? The catch is if they're focusing less on the tradable goods or export sector, and they're not counting on us to buy that stuff, then we can't count on them to buy our treasuries. We're losing one of the primary players in our audience that buys our treasuries, subsidizes our government, subsidizes our way of life. What happens if they go away? I think if the Chinese go away, that's the equivalent of at least 2 percentage points, if not 3 percentage points, increase in interest rates. So again, you just do the calculations on the national debt and what the interest component is. We're dead. You can't do that. The non-technical, you're cooked. Can't do it. So China and Russia. Russia was actually the largest liquidator of treasuries this last year, about $30 billion in treasuries liquidated. And the game's over. They don't want to manipulate their currency anymore. The Chinese have allowed their currency to appreciate 35% over the last 5 years. They're increasing wages to prioritize the household sector instead of the export and sector. Again, why is that relevant? Why is a bowl of rice in China relevant to us here in the United States? It has everything to do with the U.S. dollar and the U.S. Treasury market. If you want to keep world reserve currency status, which at least with the privileges that it carries, I think you might, and if you want financing to be relatively inexpensive, these are very critical issues. So recovery is not here yet, not a recovery yet. Stock market is not the economy, and that's what Wall Street would have you believe. Wall Street would say, look at the stock market, it's going up. Things have never been better. Jobs report was good. We'll get into the jobs report in just a minute. I want to show you U3, U6, and show you some of the ways that they play games with those numbers. But the intended wealth effect was proven to be ineffective. The 3 different papers were presented at the last Jackson Hole meeting. This is where the Fed and all the central bankers of the world get together and kind of share ideas. 3 papers were presented that said, current Fed policy is bunk. It doesn't work. You've got to change course. And what was the Fed's response? So what? What are we going to do? I mean, we've played our cards. We've just got to let this play out. That seems to be the Fed's attitude. Asset price inflation, that's what they've gotten in the stock market. To some degree, that's what they've gotten in the real estate market. And this is what's critical to understand. Asset price inflation always precedes consumer price inflation. The economist who explored this was Richard Cantillon. Cantillon was business partners with none other than John Law of the Mississippi bubble. He understood something about inflating currencies, creating bubbles, what happens when you increase money supplies and ultimately create a blowout in terms of an asset bubble and then a burst. More money was made and more money was lost. I mean, this is one of the classic speculative bubbles, the Mississippi bubble. And Cantillon was sort of the economist saying, well, here's what happens, here's how it happens, here's how we can get it done. This is what's underappreciated. Right now, you see very low levels of inflation in the economy. Official rates of inflation, we'll look at some alternative measures of inflation in a minute, but low levels and low expectations of inflation, what they don't realize is that they've already put it into the pipeline. We've had asset price inflation. That's the first step. Asset price inflation first, then consumer price inflation. In other words, a bag of groceries, a gallon of gas, a gallon of milk, it's going to cost you more 6, 12, 18 months from now because of Fed policy back here that impacted the stock market and real estate here that now impacts your pocketbook here. Employment figures, they've improved. They've come from almost 10% to 7.2. That's the U3 statistic. U6 includes discouraged workers, and there's another measure which doesn't take all of the scrubbing that's done by the Bureau of Labor Statistics and puts it closer to 23.3%. John Williams of Shadow Government Statistics figures that's where the real unemployment rate is in the United States, about 23.3. If you just look at U6 and are content with that, then you're about 13.6. 7.2 is interesting because what happens is when you shrink the labor force, in other words, let's say you've been looking for a job and you just hang it up. You're discouraged, it's been over a year, forget it. You know, I'm just going to move in with mom, live in the basement, dad's going to complain, but who cares? I just got to do what I got to do. You're no longer looking for a job. You're no longer in the labor force. If you're not in the labor force, you're not a part of the math. So you take those who are working, those who can work, and do the math, and you come up with 7.2. If you shrink the number of people who are in the workforce, and that would include people retiring. If you retire, you're no longer in the labor force. You shrink the labor force, and that makes the number of current workers look good. So that the statistic is improving without a huge increase in jobs. In fact, this year, 954,000 jobs created. Out of that, 713,000 jobs, temps, part-time. I mean, so part-time job, you see what I'm saying? 954,000, 713,000 of those are part-time? There's not only a problem with the quantity of the jobs, there's also a problem with the quality. Not a recovery yet. Food assistance. In 2000, we went from 17.2 million recipients. Fast forward to 2009. 35 million recipients. NBER stands for the National Bureau of Economic Research. They announced recovery and the end of recession, and yet, from the point where we have been in recovery and out of recession, according to the NBER, we've added how many? 12.7 million new people to the food assistance programs? I mean, so yes, there has been an impact from Fed policy, but it's been very focused. And it has had nothing to do with the larger economy. 11 million today receiving disability payments, 57.6 receiving Social Security, growing rapidly given to the demographic boom, the baby boom generation, 82 million households on Medicaid. The part that Romney had wrong was that it's not 47, it's 49%. It's 49%. U3 and U6, just briefly, understand that when they publish the numbers, and again, I told you 7.2 was the latest unemployment number, and then 13.6 was the U6. Understand that between 1979 and 2012, once they've published the number and you're no longer looking, guess what they get to do? They get to come back and revise the number. Do you know how much they revise the number on average? 85,229 jobs. That's the average revision to the number that they publish, which can be anywhere from 20% to 100% of the total number that they publish. These guys have PhDs, some of them in math. And so this is the challenge. We have a Fed that's making policy decisions on numbers like the 7.2, and yet we have as much as 85,000 jobs revised in a single month. That's the average going back to 1970. Again, it's a bit of a farce. But as I mentioned, this is where we're seeing, I want to say something positive. Chuck, last night you were saying that we were gutting the middle-class workforce by sending jobs overseas, and have been for years. The blue line and the red line are two very different stories. The red line is the sad story of manufacturing jobs, and this is not, you know, going back in eternity. This is just over the last 5-10 years. We see a decline in manufacturing jobs. Guess what the blue line is? Well, if you can read the top, restaurant and bar employees. Again, it's a quality issue. We are adding jobs, but we're getting rid of workers that are making stuff to sell to the world, and now it's happy hour. Only it's not so happy because that's the only job they can get out of college. And what do you do with the student loans? I mean, if you're looking at consumer credit, the one area that's blossoming in consumer credit is student loans. There's a radical revolution coming in education, and people are going to think twice about what the value is that they're getting for the money that they're paying, and that's coming. I'm going to skip over the monetary base. Well, let me say something about it. Fort Lewis College Foundation is something I'm involved with. I help advise on, and there's a gentleman, Robert Haugen, just passed away this year. He showed up one day to our meeting, and he starts feverishly handing out this chart saying, in my 25 years as a finance professor, I've never seen anything like this. You realize what this means. And I do, but everybody else in the room was like, Bob, you want to tell us? And he says, this is a wall of water. This is liquidity that has been created by the Fed and just has to get out. This is your potential superinflation. So let's figure out, you know, because we're talking about how to manage the assets of the endowment for, you know, this 4-year state school in Colorado. And so what does this mean? What are the inflationary effects? And I said, well, you might want to own some gold. He's like, yes, we should own some gold. So, I mean, we went through our various options, but everybody in the room is looking at this going, should we care? Should we care? And I think that's most people's response to looking at charts. This one you really should care. You should care because the Fed has done the dirty work to create not only a little bit of inflation, but a whole lot of inflation. The only thing that's broken here is the lending mechanism. The velocity of money, the means by which a dollar goes into the economy and gets turned over and over and over. Velocity is a 6-decade low. If we had normal velocity, which is the normal turnover of funds in the economy, you have a paycheck, you deposit it, you go spend it with, you know, the 5 and dime, they redeposit it, spend it. That's the cycle that they call velocity. If we had normal velocity, this $3.5 trillion that's been created, you're talking about a multiple of that. It's not a $3.5 trillion footprint. It's a 10, it's a 20, it's a $30 trillion footprint. How do you go from benign inflation, zero or low inflation expectations, to people panicking and people realizing that this is an inflation we didn't see coming? It's already there. And so it was interesting. Bob kind of throws it down with great enthusiasm. We miss him. He was a great contribution to the team. Lending mechanisms broken. This chart it runs in parallel. It looks the same, right? Well, monetary base, and here's excess reserves of depository institutions. Banks are not lending. Banks have taken the cash that they've gotten very inexpensively from the Fed, wait a minute, and they've just redeposited with the Fed. But they're getting 25 basis points interest on the money. So they are collecting a little bit of interest along the way. America's way forward. What are the options for policymakers? The Congressional Budget Office said, okay, we can get ourselves out of this. This is not a problem. We need double-digit growth rates for decades to come. So theoretically possible, but again, less than likely. I mean, because remember, we haven't. I didn't want to bore you with another chart. we haven't had a single year of double-digit growth rates going back to the 40s, and we need uninterrupted, for decades, double-digit growth, and then we can get caught up on our debt payments. We can get ahead of, we're on the wrong side of the debt curve, but we could actually get on the right side of the debt curve and handle it with those kind of economic growth rates. Repression, we talked about that. New concept for you, but it's politically palatable because no one understands it. And you're basically, again, by zero interest rate policies, you lower rates and you redistribute capital, redistribute income. I take from you and I give to the banks and I subsidize the national debt. And I can continue to increase my debt just like the Japanese have, as long as I can keep rates at a very, very low level. It's a redirection of income. So repression, I highlighted it because it's already being done. And it is another form of taxation. Inflation, another form of taxation. It's the next politically palatable because very few people understand that either. Keynes said 1 in a million understands inflation. And it's in part because it happens so subtly, so slowly. Does anyone know what this is the 100-year anniversary of? Creation of the Federal Reserve. How have they done in the last 100 years with their primary mandate of managing price stability? The dollar's lost 97% of its value. But the thing is, because it only happens onesies and twosies at a time, 1% here, 2% there, nobody notices. So again, it's an interesting form of taxation, yes, clearly without representation, and without announcement. See, when you go through the legislative process, it has to be passed, and constituency groups get to say, I don't want my taxes raised, or maybe you should raise it on them. It doesn't happen that way with inflation. They get to do whatever they want, and this, I think, is a key thing that our creditors, our foreign creditors, are picking up on. The stated rate of inflation is 2%. Real inflation is something more than that, which means that the difference is what we're gigging our foreign creditors for. We're stealing from our foreign creditors. We're stealing from the Chinese and Japanese. We're going to pay them back with cheaper and cheaper dollars. So inflation. Confiscation is another policymaker's option. It's very offensive, and at least to those who are on the receiving end, the 1% qualify as a minority, and this is what you need. Democracy is a 51% tyranny. If you get enough people lined up and say, this policy is good for us, it's bad for you, but there's only one of you and you can't do anything about it, that's what happens. What is the future of our tax code over the next 5 or 10 years? It's going to be nasty. It's going to be ugly. It's going to be what you might have expected in the 30s and 40s, you know, where the top tax rate above $50,000 in income, granted $50,000 was a lot in the 1930s, moved to 90%, over 90%, actually. So confiscation, less of an issue today, but something that you can anticipate. Default. Why not just default on the debt? Why don't we tell our creditors to go away? We'll pay them pennies on the dollar. It doesn't happen when your debt is denominated in your own currency. It happens very commonly when debt is denominated in a foreign currency. So I'm Brazil and I borrow from a London bank, and the London bank is smart enough to know that I can run the printing presses in Brazil. So the London bank doesn't want to denominate the debt in Brazilian reals. They want it in pound sterling so that I can't cheat them via inflation. So they denominate it in their currency, which means anything I do to monkey with my money system, guess what happens? The hurdle to pay back is that much higher. So when you don't have your debt denominated in your own currency, you're far more likely to default. That's not our case. So default, no, it's not on the cards, at least at the level of national debt. There's another solution here for policymakers. We could require all members of Congress to carry a sidearm issued by the manufacturer of our choosing. The problem is this would require elected officials to shoot straight for once. Real quick, debasement of money is a debasement of society. I want to illustrate this from the 3rd century, the 16th century, the 18th century, and the 20th century. Money is a medium of exchange. That's what it is most basically. It's a store of value. It has a lot of other characteristics. But as a medium of exchange, it requires that you trust it. It requires that it be legitimate. And if there is a breaking of trust which occurs it is when money is intentionally devalued. So what accelerates, this is a critical point to keep in mind, what accelerates inflation from low levels to medium levels to either super or hyperinflation, it's not a monetary event. It has nothing to do with money and finance. It has everything to do with psychology. It has to do with a breaking in trust and a breaking in confidence. So what is the level at which, I mean, you can try to pencil out, well, what is the level at which confidence breaks? No one knows. I mean, it's just you watch a school of fish, and they're going one direction, and the next thing you know, they're going another direction. And it happens that fast for no particular or apparent reason. When inflationary expectations change, velocity increases because people want to get rid of their money, right? You get paid this morning and you know that inflation is very strong. You want to spend the money by the end of the month. Certainly you're not going to save it. So you spend it. And the person who receives it wants to spend it too. So you've got money that's going through the economy that much faster. The deception is when velocity increases, the first impression is that the economy is in recovery. Look at how robust the activity is. When in fact, it's at the front edge of a superinflation. So be aware of that component. Again, so we'll start with the 3rd century. Declining silver content in the Roman denarius. This is the 3rd century where everything sort of broke apart. It was a long period of decay, and that's what happens. You have these long periods of decay, and then a point where it accelerates. And if you study the exponential function, whether it's bacteria in a petri dish or compounding interest, you get to see radical growth rates the longer it goes on. And that's what happened with the denarius, where there in the last 50 years, there was a lot of turmoil, a lot of chaos, a lot of breaking of social trust, a lot of questions about what is wrong, I mean, a lot of discontent amongst the Romans. And I put this up here because this is the 3rd century crisis. It happened in 300 to 303. Okay, that's the time frame we're talking about. But the 3rd century, you have the number of emperors here, between 251 and 300, more emperors in that period of time than in any other period in Roman history. Again, you're dealing with social tensions and political tensions, and people don't know what's happening, and why can't they pay their bills? And today, it's the dual-income family can't even pay their bills. But we don't understand, we can't connect the dots to monetary policy and the real consequence of goods and services costing more. So we take it out on, well, in this case, it was originally politicians. Ultimately, the politicians turned that around and blamed the Christians. Diocletian tried fixing prices in 301. When that failed, the blame game began. And in 303, Diocletian unleashed literal hell on earth for the early church. And the justification, the social justification, the commentary of the day was they angered the Roman gods by refusing to worship the Pantheon. And so there was, again, even then, the leadership probably got it, but the people didn't. The 16th century, it was blame the witches. If you look at, this is Britain, British witch trials peaked as you, and again, so in the blue, you have the incidence of witch trials, which increased significantly with an increase in the price index, which is the equivalent of inflation. Inflation increases, there's greater social tension, everybody's looking to everyone else to blame what's wrong, what's not right, what's changed, who can we blame? 16th century was the witches. 18th century was the nobility. Between 1789 and 1796, with that short period of the creation of the assignat, the French currency, lost 100%. After it had lost about 40% of its value, had started to roll. 17,000 heads just in that 1793 to 1796 period. Blame the nobility. Blame the Jews. An ounce of gold in Germany in 1919 cost 170 marks. By 1923, it cost 87 trillion marks. It was an inflation rate, again, the exponential function. You looked at the decline of the denarius. Well, to look at the inflation rate, it's just drawn, we drew it differently. That's the inflation rate there. Havenstein was the central banker of his day. He died in 1923, probably under a lot of pressure. Well, understandably. He died in 1923, and they went back to a different mark. The German mark was then backed by mortgages. That didn't work either. It worked for a couple of years, and what it was lacking was something even more foundational and fundamental that didn't require people in the trust equation. It just was stuff. And so they finally went back to the gold mark a few years later, and that reestablished stability for the mark. Debasement of money equals debasement of society. 21st century, who do we blame? Is it the 1%? Is it conservatives? Is it traditionalists? I don't know that we get to pick how that ball bounces. As Pericles said, the key is not to predict the future, but to prepare for it. Here's the half-life of the dollar. If you price the dollar in gold terms, this is what has been happening over the last decade. The dollar is in severe decline. I've circled that little counter-trend move where gold has fallen back in price and the dollar has rallied considerably. Oh, except when you put it in context and see that you're talking about the death march of the dollar. Minor hiatus, a stop for a break of water. But this is a very troubling chart. We're going to talk a little bit about the stock market, a little bit about gold, and then we'll close. I think I have 7 minutes, which is going to be tough. Quantitative easing has been what's primarily pushed up the stock market. Put the numbers here. The Fed announces QE1 and then increases the size of QE by 200%. That marks the bottom of the market, 1 and 2. QE ends, and we begin a decline. We announce the next round of QE, mark number 4. That next round of QE ends, mark number 5, market declines. QE 6 is announced, and then we have, again, by 7 and 8, hints of QE, which is likely to remain, and then we double the size of it there at point number 8, and the stock market continues higher. The stock market is moving higher because of liquidity that is being created by the Fed. It's not being driven by economic fundamentals, an increase in sales, better revenues, and whatnot on Wall Street. So you're dealing with more or less the walking dead in the equity market. We can talk about that a little bit later if you'd like. Another element, again, contrary indicator, the stock market's moving higher. What is this? This is New York Stock Exchange margin debt. I want you to note the previous peaks, 2000. Margin debt peaked. What is margin debt? Margin is money that people are borrowing from their stockbroker to buy stocks that they can't afford. They don't have money for, but they figure it's such a sure bet, why not use the house's money and increase our total rates of return? Because it's such a sure bet. 2000, we hit a peak in margin debt. 2007, we hit a peak in margin debt. Last week, we hit a brand new peak in margin debt, $401 billion. Folks, I'll just say this very clearly, very simply. If you have very much in stocks, you would be well advised to start moving some of that into cash. Do you need to run screaming from the room and call your broker? No, he won't appreciate it. It's Saturday night. But you need to be aware that we got here on very unhealthy means, and mean reversion can happen very quickly. Prices can correct very, very fast. This is sort of a lesson in nominal versus real pricing. I want you to look at the left-hand side. And the left-hand side is the bear market of the 1968 to 82 period. Now, the bottom left, you'll see the Dow in decline, in decline, in decline. But wait a minute. If you look at the same Dow, just don't factor out inflation. You've got the nominal Dow. It just looks like it's moving sideways for 10, 12 years. When you factor in inflation into a real rate of return, then you get to define what you kept in terms of an economic benefit. And the reality was, as inflation accelerated through the 1970s, what was a flat market, 68 to 82, in the Dow and the S&P, it was flat. It was actually dangerous. It was terribly dangerous, and you lost your shirt. We have the same thing happening here. Fast forward to the right-hand side, you have a bear market masked in nominal prices as inflation is underestimated. And the real status of the Dow is that we are in a structural bear market. And as inflation accelerates, you can take the nominal price of the Dow and S&P, and you can kiss it goodbye. It doesn't matter. It doesn't matter because what you keep at the end of the day is what you keep after taxes and after inflation. And inflation, I think, is going to take a bigger and bigger bite. Here's John Williams. If you look at the red This is the difference, what he marks as inflation, closer to 8% currently, compared to the blue, which is the official rate of inflation, closer to 2%. I put this up here, and this represents a market snapshot. I think if you could wrap your mind around this relationship between the Dow Jones Industrial Average and gold and how it's operated over the last 120, 130 years, you would be so well served. You can either be at the receiving end of one of the great transfers of wealth or at the giving end of one of the great transfers of wealth. And that's what's occurring. This chart captures what side of the equation you want to be on. There's times where you want to own financial and paper assets. And there's times where you want to own tangible assets. And gold would just be one of them. Ranch land, art, you name it. If it's real, you want to own it. This is gold compared to other assets. The S&P 500, again, over the last 10 years, we've seen an increase since 1971 when gold was finally let loose and was able to trade in the marketplace. You realize it was fixed at $35 from 1933 to 71 because of government decision making. It was just the way it was. When it traded freely in the market, since that time, it's increased 38-fold. 38-fold. The Dow and the S&P in that same time frame have increased about 18-fold, and here in the last 10 years, gold, which is a terrible investment, no one should own it, is up, what is it, 397%, and silver's up around 467% as of today. And that's factoring in a major correction in both of those assets. So you're just getting above, you're just moving into new highs on the Dow and the S&P. Valuations are stretched. We could spend all night just talking about various ways of measuring overvaluation in the stock market, which we don't have time for. But gold is supposed to be a terrible investment, and it's still outperformed anything on the planet by a wide margin. And I think we know why, because intelligent investors have been moving that direction, not liking what they saw in the dollar, not liking what they saw in our debt picture, not liking what they see in the derivatives market, not liking how much leverage they see on bank balance sheets, and they're wise to do so, because these cycles have yet to complete themselves. Production costs, I'll just mention something about that. Production costs on an ounce of gold average about $1,200 to $1,400 an ounce. So that's what it costs the miners to get it out of the ground. It's a little bit more than that in South Africa, about $1,500. There's a few mines up in Canada that are closer to $800, but the average is closer to $1,200, $1,300. Here's your worst case scenario. Gold goes to $800, the gold mining industry goes broke, and in 3 years, gold's at $40,000 an ounce because there's no mining industry and no supply from the mines. That's your worst case scenario, is a very sad and tragic move to $800 on its way to 40,000. Don't quote me on 40,000. I'm just being facetious. That's not going to happen. We have a floor in the gold market right around its cost of production. Strategic actions I'm going to give you, and then just sort of an orientation. This is a different triangle than we looked at, but it helps us organize the way we allocate assets. You organize and allocate a part of your assets towards the mandate of growth and income. That can be stocks, bonds, mutual funds, annuities. You can orient part of them towards liquidity. That's cash, treasury bills, CDs, even foreign currency, money market accounts, and things of that nature. And a third towards insurance, which we would consider gold, silver, platinum, palladium. This kind of a balance keeps you in the game in the case of growth, keeps you well protected in the case of inflation, and well protected in the case of deflation. I mean, it's sort of best case and worst case scenarios. What I'd like you to say is that's the stupidest thing I've ever heard. Because the great thing is this works for the stupidest of people. It's about as watertight as you can get. You don't have to be 100% right. And anyone in Wall Street who tries to be 100% right, guess what happens? They're 100% right one day and they're 100% wrong the next day. So this is a balance that focuses on all of your major asset classes. Haven't included real estate in here, but should. This is really liquid assets. 7 points for you to consider as we wrap up. Eliminate debt. It's very practical. You need to do it. If you haven't done it, get aggressive about it. Reflect on areas of system dependency that you have and move towards greater self-sufficiency. System dependence will struggle to survive. We're talking about food and water. We're talking about medical self-sufficiency. We're talking about power. We're talking about money, having things that you can trade, including gold and silver, but not limited to that. Transportation. How many tubes do you have for your bicycle? I mean, if you had no other transportation, we'll get to this in the panel discussion here in a moment, but, you know, assuming that there was something like an EMP, do you still have the ability to travel 10 miles on something other than your feet? I mean, so there's some practical things there to consider. Balance your portfolio between asset classes, emphasize real things. Ken Rogoff does that name ring a bell? I mentioned him earlier. He's an economist at Harvard, and in a private soiree this summer, his recommendation was buy mayonnaise and the old masters and hide them, because the government is going to tax you out of existence. Those were his words. And the problem I have with mayonnaise and master art is it's very difficult to bury. Gold and silver is not so much. And I think in terms of focusing on real things, ranch land and real estate that you could put in your pocket, so to say, precious metals, I think, fit that bill. Raising cash up to 1/3 of your liquid assets. Raise a significant amount of cash right now. Whatever your obligation, if you're committed, overcommitted in the stock market, if that's your 401k and equity mutual funds, raise cash now. 1/3 now. Position 10 to 25% of your liquid assets outside of the United States. Toronto's awfully close. Switzerland's farther away. Singapore's even farther away. But you need to look at where there's rule of law, predictability in terms of government, and if you're going to have money someplace else, assume the worst about the people who have it. And that's where the Swiss, I mean, frankly, they're the most boring people on the planet. Forgive me if you're Swiss. But I mean, it's how you had 90,000 people at the peak in the 1970s as watchmakers. One country, 90,000 watchmakers. Attention to detail, fantastic. They're blessed with things I could never do. The money's there, it's easy, forget about it. Having gold in Switzerland makes sense. Having gold and silver in Toronto makes sense. Having gold and silver in Singapore makes sense. You can do that, you should. 10 to 25% of liquid assets outside of the United States. I don't think there was a Jewish family in Germany that ever regretted having diversified their assets geographically. Develop community with like-minded people. You're already about this. This is who you are. This is why you're here. This is what you're doing. I would trust my life with. Is that true of the person who's sitting next to you? This is, you know, our weekly commentary. We try to facilitate a sense of community, education, a very steep learning curve, but one that empowers you to understand what's happening in the world and be able to lead a discussion with friends and family members. Book discussions. We do that once a month in our office. Require everybody in our office to read a book, write a paper. They don't really like that, but you don't have to take it that far. Book discussions, Bible studies, studying and thinking about persecution. I mean, these are things that, again, you rely on a very small group of people. And in truth, your life revolves around a very, very small group of people. Pray for wisdom and guidance in the years ahead. We could add probably 50 more to this list, but just to get started. I mentioned more about gold than I did silver. I just want to say this so that you don't misunderstand me. Gold is a monetary asset, and as a raw investment, as a means by which you preserve assets during tumultuous financial times, I think it is the first and primary asset you should consider. Silver, as the investment of the decade, I would say that there's probably 2 to 3 times the amount of growth. That doesn't mean that you put everything that you have into silver. It just means that there's other variables that add to its supply and demand dynamics, which make it as intriguing, if not more intriguing, than gold. So something to consider there. With a growth dynamic, so what did I ask in the beginning? I asked that you watch something. Watch The Fuses Lit, American Reckoning. If you haven't picked that up at our booth, see if we have any more. If not, make sure we have your contact details, and we'll get that out to you. I asked you to listen. Wednesdays we do our audio commentary. Friday we do our written commentary, and that's on our wealth management website. But we condense a lot into these podcasts, And I'm probably reading 4 to 6 hours a day. You get the benefit of all that in about a 30-minute time frame. And if that's of value to you, again, what I would like to see is people empowered to have and lead the best conversations around the water cooler at work, around the Thanksgiving dinner table, but where you're asking the questions and you're guiding the conversation and empowering the people that you love to think well and act well. So anything that we can do, I mean, again, obviously this is limited to finance and economics, but I think it would be helpful for you. And last, I want you to read these two things. I want you to read the True Gold Standard. True Gold Standard is by Louis Lehrman. It's very short. This is less than 100 pages, but a very easy roadmap, understanding not only the role that gold played in our monetary system, but the role that it very easily can play. And understand that if we do cycle through and experience what I think we will over the next 3 to 5 years as a serious economic collapse, there's going to be a different set of questions that are asked. And I want to know if there's one of you which will be the person with the answer, with the voice and the ear which is willing to listen, the policymaker who's willing to implement because you made sense. Make sure that you make sense and make sure that you've got good answers when the questions are asked. The Gold Standard, an easy read. We have 100 copies over there. Fastest 100 people get them. No stampedes. It's not a very expensive book, $9, $10. And the second is When Money Dies. Adam Ferguson wrote this book in the 70s, and you have to understand there's lots of things that you can read about the economics of inflation, and it's totally boring. It'd be up my alley, but it would just kill you. Yeah. This is about what happens to a culture and to a society and to families when there is inflation and severe inflation. So to understand those ramifications, I think it humanizes what is really a desperate situation. It's not just a question of numbers and how many more of them there are on a currency note. It lets you know what the real costs are, the stress and strain on the fabric of society. So read those two books. The Gold Standard, the True Gold Standard, and When Money Dies, and I think you'll find that, along with some of the other resources we mentioned, an aid in your decision-making over the next couple of years. Obviously, pray for wisdom and guidance. These are amazing times to be a part of. I'll end where I began. I tend to see these things less from, this may sound like heresy, but I think that's allowed a little bit, right? Just a little bit. This has less to do with eschatology in my mind and more to do with stewardship. I'm going to assume that I don't know what's happening tomorrow. And I'm going to assume that if I have a talent, I'm supposed to make it into 10. A talent was the equivalent of 1,087 ounces, if I've done my math right, of gold. To turn that into 10,000 ounces of gold, it's a project. It's skillful management. It's skillful management. As long as we have, if that's a year, if that's 5 years, if that's 50 years, if the Lord tarries, you are responsible. You are responsible for good decisions and you're responsible for poor decisions. And that begins, I think, with education to where you can make wise decisions. Get the education before you start making decisions. I have 3 kids, 1 more on the way in March, and I don't hope that the world ends. I hope that I get to raise my kids and see them grow up, and I hope to see their kids and grandkids. And on the other side of the equation, I'd be just as happy if the Lord returned. But I do live my life as if the generations will hold me accountable for every decision I make. And we return to that perspective triangle, not the monetary one, but the one that showed the declines that we have in the monetary economic, in the moral and in the social and political, and in the moral and the spiritual. And there's degrees of accountability in each of those. So not taking your growth in education and application and livability in each of those areas would be absolutely tragic, and you will be held accountable. Thank you for letting me share some ideas. I wish you well.
Koinonia House is a nonprofit Christian ministry that is supported by the purchasing of materials and donations. To learn more about Koinonia House and the materials that we have available, visit khouse.org. And please be responsible in the sharing and dissemination of this information and respect the copyrights therein. Thank you.